Hey everybody, what's up? Sorry I'm late here. Gonna get everything going. Got music playing. All right, opening out the door. Looking pretty solid. Resilience is good. I like what I see. Go long up, looking solid. 484, 483. Oh yeah, that's great. Oh shit, come on. Trading. Go long right here at the open. Right, 1 second, you guys. Knights Queen, beautiful golden setup. Let's take it. What's the worst that can happen? Okay, round opening. Right at the top of the box. All right, friends, what's up? Muted. I'm eating my breakfast real quick. Got a late start today. Good morning, friends. Did it good. Half gap. Nasdaq is just opening and dumping today. I think something going on in the news or anything that I know of. Boo. Fed to cut rates on a poll by 100 basis points less. According to 72 economists, blah, 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 blah. Oof. Let's check out keys really quick. Oh, and we also have limited upside on the VIX. Damn it, so we're gonna have some play there. VIX is still below triple B, so things are pretty okay. QQQ hedge breaks. Let's watch out for that. That sucks. I could fuck us up today. Pretty decent. We got the what's called the golden setup today. Just looking lovely. Good morning, guys. All right. Let's see how well this goes. It's gonna be a really solid trading day. If this golden plays out, this is gonna be a really huge up day. Here we go. Vola triple B, check. Going through our rules. That's a good sign. Let me show you what all this means. If you go to the Discord. Go to our training in the Discord, walk through the curriculum. And we'll show you all the different things you're going to learn here in the summary. You'll have all the different indications that we talk about. One of the bigger ones is this thing called triple B. And triple B has to do with the style at which you're going to be, your trading style, essentially. In a certain regime of the VIX, you're going to have what we call loose pivots and overshoots. In another regime, you're going to have sharp pivots, and a BBB tap can also pivot the S&P. I'll show you what that means. So loose pivots, right? I'm going to handy dandy pencil here. Hold on. Here's what we mean by loose pivots and overshoots. It's two different scenarios. So a razor sharp pivot means that price will hit some kind of level. Pretend this is like hedge pressure, right? And it's going to bounce pretty good. Or it's going to hit it, maybe play around just like once or twice and then go. It's going to move pretty quick. Loose pivots and overshoots means that, you know, you can have this. You can have where it hovers, like it doesn't get there all the way. It hovers, or it overshoots, like a hedge pressure. Like it breaks and you stop, then it breaks and you go. Does everyone understand? On the same page here? There are two different styles of trading. So we talked about yesterday. Did you guys all like the video we made yesterday? Yesterday was fantastic, wasn't it? What we call trading on the first day of the month. One of my favorite concepts to teach. The first trading day of the month, which is yesterday. We're getting closer to break even. Resilience is still looking fine and dandy. The problem, as you have here, that VIX is bouncing. You know, like this, right? I know. Sorry, no, don't listen to me. That's not VIX. Come on. All right. VIX is good. Oh, thank God. Okay, VIX is great, guys. Okay, this is perfect. This is gonna be the best trading day of the month. I feel like this is it. We're touching upper DD today. There's nothing in the way of the VIX. What I'm gonna do, because of that, I'm gonna draw a really big smiley face right here. Just to show how happy I am. He's even gonna have like, so we'll see. VIX is looking great. I'm terrible at drawing smiley faces. The bigger eyes actually makes it creepy. Up here is a frowny face. Okay, we're gonna teach you guys something about the VIX today. So on the Tuesday before the third Wednesday of every month, you guys are gonna learn something. We do this little calculation right here. This wraps up a phenomenon called contango, backwardation, into our strategy. And this level is in our Discord. We publish it. We teach you how to do it. And it's going to be there all month, and then we post the new one when it happens. Hold on one second. And so when you're above or below it, it's going to dictate how you're going to trade. The same sign, the same setup. And so bull long ups or whatever you get, first of all, today, make sure we're monitoring the things that matter. We have resiliences are looking okay and our rules. But what you're going to do when you're below this triple B level is you're going to look for the market to make decisions really quick. It's going to bounce and be a strong bounce. Or if it's wrong, you're going to know quick. It's not going to hover up around the levels. The market's going to be liquid, very liquid, not volatile. With volatility helps you understand the liquidity. Are there going to be traders there or not to offer resistance to the move or not? So when you're trading below triple B, which you are now, it's either going to hit it and go, or it's going to hit it and lose. See, right now we're hitting half gap under this regime here, the one where we're trading below this triple B level, which means there's not, the market's very liquid. There are buyers here. We're going to have very quick. Let me zoom in on this. I think it's slightly bigger. Look at this 1B thing right now. Let's just watch it. Do you see how it's making a decision very quick, everybody? Yes, yes, yes. You'll see that? It's not going to hover at your level. Give me 1 second here. So what you'll know also really quickly if you're wrong, which is the best part about this environment. Give me a second, you guys. Y'all look quiet today. How are y'all? Y'all have a good Monday? Have a good Tuesday? Wait. I'm about to make it to where I'll just play whatever music I want. I love the lo-fi music, it's chill, but I think I want to start going into like my old days when we used to do Zoom only and we used to play like name that tune and guess the movie score and more fun stuff. I don't care about the revenue sharing on YouTube. They can give away my $3 a day. Oh yeah, I'm good, Louis. All right. When you're in this area, what happens is sometimes it'll hit short. Sometimes it'll hover for a long time and then make a decision. Or sometimes it'll overshoot and go. The harder, that region is harder. This type of environment is much harder to trade in. Or like it can, the crappy thing is it can just, you can lose and it's just harder. So right now we're here, we're looking for razor sharp pivots where it's going to bounce and then hold pretty well. If I'm wrong, I'll know I'm wrong very quick. That's the best part. Like if this hovers here for a long time, like it's trying to do right now, like if it's hovering at the level, it's not bouncing fast enough for me. I mean, I really want it to. It's going to help me kind of escape a bad trade early. You want it to make a decision pretty quick. Like it's going to bounce once and maybe bounce again and go. You're not going to see a lot of hold up. Hold on one second. It's like right now, we're actually, the pivot I'm looking for is the bull long up, which is gonna be right here at hedge pressure. So we'll look at any pivots are gonna have a harder time bouncing under the other environment, because the higher the volatility, and if volatility is hedging itself higher, we've all noticed that in this range right here, where the market is underpriced volatility, months in advance, that you're going to get to a place where it's less liquid. There'll be less buyers and sellers. That's what liquidity is. So less buyers and sellers creates a regime where it's going to be hard to find buyers at your pivot. So my one thought here, and when you have that other environment you're trading in, which we're not in right now. And again, this is a static number that's going to be there all month. A lot of times, if this is your pivot, we do the one strike distance rule for stop. So if the S&P be like 1 point, let's make up a number, 483. So 482 would be like my one strike. So if it hits here, say that like normally, let's do two different examples. And my normal position size is a basis of 10. Okay. So normally when it falls and hits your pivot, I'll hit my max position if all the lights are green and yellow. But in the other environment where it's just less than truly less than in this environment, I'll split up and then do my other one right at my stop. Because I'll expect it to possibly overshoot before it goes. I get my cost basis much lower. The one to the right is actually a lot of times going to be your bigger profit trades. Volatility tends to create. Remember, this is a when we underprice volatility is going to crunch quick. Here, volatility is going to expand. And crunching volatility is where markets do this. Volatility expanding is when markets do this. Okay. So what we normally do when you're in this regime right here, you're going to get more volatility. Therefore, you're going to get more rapid movements. This one, you're going to get more clean movements in a straight line, or more decisive, liquid markets typically, without a lot of hesitation, right? You can see that NASDAQ itself is moving without a lot of hesitation. See, the volatility completely collapsed really quick. Whoops. Like NASDAQ, right? Volatility is tightening up. That big V is already tightening up, and it's starting to decisively move. You see that, everybody? Yes, yes. Everybody, yes. What do we got in 10 minutes, Jace? My man. What we got today? Richmond index. All right. Okay. Now, just talking about this, whenever you get this one, your cost basis at hedge pressure. We get this one, your cost basis can be below hedge pressure. You can get like a better entry, albeit it's like a scarier trade. But what you want to do is you want to split up your normal position into a couple of bites. Like here, since I'm at Triple B, I decided that I'm going to take a position here and here because resilience is positive. And if it starts to lose this, I'll probably stop, take it for down here, and then try again at hedge pressure for the long. I could also do like 5, 5, 5, 5. I could hit each one of these pivots and build a cost basis down in here. Res was positive enough that I just want to take a stab right here at half gap. Betting on the decisiveness of the market, the pivots being strong, you pivot very strongly up here, which it's trying to do. Half gap is really strong. This is bullish enough with the 4, the 5. It's holding in there pretty good. And the market's looking clean enough to go. You see how this works? Why am I hitting it heavy and not hitting it heavier at hedge pressure? Because half gap is support. I'm looking for a razor sharp pivot. Look, it barely overshot a little bit and it's bouncing pretty quick. You see how this works? It's a lot more decisive. And again, doesn't mean that it hits exactly. Overshooting pivots means that you'll know it's overshooting. When I drew it earlier, it's going to either hit it and go, or it's going to hit it, maybe overshoot tiny little bit once or twice and then go. It's going to move quicker. And you'll notice that. So I don't split up my trade as much in the 2 different entries. You see how it's working right now? Hopefully, fingers crossed. If you don't wake up and analyze the VIX and the style of trading that you're going to experience, you're going to have a bad time. If you're an index trader, especially those of you doing trader funding programs, you're going to understand the state of volatility at all times. That's going to affect how you trade. If trader funding programs, you get this like trailing line on your profit and loss, that as you go up, it goes up, and then you lose, you blow up. You always have to understand that volatility is going to be wider moves. And so you want to play smaller when you know you're going to have that environment. Because you may be right on the trade. You may think you're wrong. We ultimately were right because the pivots were just loose. And again, why are the pivots loose? Is because it's a volatile market. It's a lack of buyers and sellers at the current price. Volatility is the inverse of liquidity. We always talk about this. The more volatility something is, the more volatile something is, the less liquid it is. And liquid is like the amount of buyers and sellers clustered in an area, and that area is the price. So, or at a fixed price, the frequency at which the item is transacted. So an example, there's a neighborhood of 100 houses. Let's talk about liquidity real quick. And of those 100 houses, the price is fixed at 500 grand. And at that fixed price, one house is sold every day. Okay. There's no such thing as a base state of liquidity. So let's just invent one. 100, your normal day, you'll sell, actually make my number. At 500K, you'll sell one house a day in that neighborhood. So if a month later at 500K, 5 houses are sold a day at that price, nothing changed other than frequency, then the market just became more liquid. So so the state of liquidity is going to give you a couple of things. On a time basis, just some basic math here. As frequency of transactions, and when you draw a bar like this in your differential calculus class, you remember that means fixing something. So we're going to fix the price. The frequency at a fixed price goes up. I'm just shorthanding this. Then liquid goes up. So not a changing price. Now at a fixed I'm sorry, this is not time based. This is time isn't fixed. This is the price basis. So the frequency of transactions at a fixed price goes up, the market's more liquid. 2, on a time basis, if you have the average price at which something trades, something fluctuates, maybe the houses go from 100 to 500 to 1,000 because buyers and sellers aren't agreeing on it. What you'll normally see is if the buyer was, we'll say this is called price, right? On this Cartesian grid. If the price fluctuations between here was a seller, here was a buyer, here was a seller, here was a buyer, here was a seller, they're farther and further apart from the mean price, which is the average price. As they get farther and farther apart, disagreeing on the mean price when the frequency is the same. So the frequency is the space between transactions. So frequency is here, right? Still one house a day. At the same frequency, the price fluctuates between where buyers and sellers agree around the mean price. Then also the market's more volatile or liquidity goes down. if the price converges to a level and the buyers and sellers are 1 unit away from the mean, which is the minimum they can be, then that's a liquid market. So liquidity has 2 points to it. Number one is the frequency of transactions at a fixed price. The other one is the oscillating or differential between the buyer and seller of the transaction around the mean price at a fixed time. So this is like a little partial differential equation there trying to explain. Does everybody follow? I know it's a little, when I'm like fixed price and fixed time, it's trying to baby up some calculus a little bit, but does that make sense to everybody? The more people that buy something at a more agreeable price between the buyer and seller, the faster it's a lubrication mechanic. The more lubricated the market is, the faster the transactions take place. The more the buyer and seller agree on the price, the higher the probability is they're going to flip the house, right? So you want both of those factors to be there for liquidity. So like when markets are volatile, they're just not liquid. They're either lacking transactions per minute. And so what's the reasoning for that? Whatever causes that, right? So in reality, you can think of liquidity as transactions per minute, fixing the price. A liquid market is where buyers and sellers find each other really quickly. Illiquidity can be based on lack of supply or lack of demand or disagreement of price or some other bottleneck. Resilience is looking pretty hot. Hopefully this survives. So when markets are volatile, you're going to have, again, the opposite of liquidity. It's the inverse. So liquidity is the inverse, the higher frequency of transactions. Illiquidity or volatility is a what's the word I'm looking for? The state of illiquidity can cause volatility, rapid price swings in the market as we define it as traders, because there's a bottleneck between the buyer and seller. They're not really there. So the market can wildly swing because there's not sellers and buyers in the way to buffer a price move. Buffer means to slow it down. So lack of buyers and sellers can cause the market to swing really rapidly around the mean price. So we like to say it like this, like if the market is flat, it's easy to see right here that the market's been flat all morning. Does everybody see how the oscillation between buyer and seller is rapidly crunching? Everybody, yes, you'll see that. Don't forget to hit the thumbs up button if you don't mind really quick. Give the algo some love. We'd appreciate y'all. So right now, we're in a period of like volatility crunching up. And so that means there's a lot of buyers and sellers, so that they're going to have resistance to both sides of the market, which means if the market moves, it's moving with strength because it has to plow through some thicker walls. So when volatility is crunching like this, you're going to have thicker resistance, right? So the moves are more believable. A move that plows through so much resistance is more believable than a volatile market where it's not like a thick wall. It's like buyers and sellers are more spread out. So did this, if you break through and keep going, it's because there's an overwhelming amount of buyers that just plowed through all these sellers that are all, it's like a room full of 100 people, 50 on each side, and you just knocked out all 50 people. Here, the 50 people are spread out all over. You might just plow through like 2 or 3 people just to move here. The move is less believable. So in volatile markets, your moves are less believable. You tend to trade shorter. You take what you can get. You get in, get out, take your profit and leave. Does everyone understand? So when you have these moves, like you always learn this like technical analysis junk, right? Like not junk, it's like charting patterns junk, right? It's a descending triangle, blah, blah, blah. Well, this is what I don't know, what do they call this one in your first day trading book? This is like a pennant or I don't know, something, pennant, right? You got your patterns where it's like do. Oh, it broke out. Or here's your pattern. Do. Oh, it broke out. Yes, these things are great. And they're more believable in an environment that's not volatile. So in a non-volatile environment, These patterns are more believable. But people say, well, sometimes they work, sometimes they don't. Well, did you examine volatility? No, you didn't. You just looked at the shape. See this breakout right here? It's more believable because it has a thicker wall to press through. It's a stronger move than the same move in a volatile market. This one just, you don't know where the buyers and sellers are. That's because that's what illiquidity is. You can't guess where they will be or where the price will be. They don't agree, so they're not going to be close to you. So any pattern, anything is more believable in a liquid market because it's got more force because it's breaking through more resistance. That's the way to see it. So like you just think of like your descending whatevers or your ascending whatevers or any charting type pattern that you trade on. You can use triple B to also assess that. Doesn't mean that it has to go, but it means it's more believable. Razor sharp pivots again. So a breakout or whatever, it's going to be pretty sharp and decisive because all of your resistance is clustered near the price. You're not going to likely have resistance out of the way. Liquid markets mean everybody agrees on where price is. Everybody's converged. So everybody's here and not here. Not here. So the decision is made at the converging point in a liquid market, which that triple B number helps you understand the state of not just current volatility, but the state at which volatility will hedge itself based on how people have positioned for volatility in the past. So what happens in this effect is that futures have multiple contracts that can trade at once, different expirations. And so this one that we're currently trading right now, the February contract, has been trading for many months before now. While January was still active, February was also active, right? If you're to put them side by side, while January, which is this guy here, February was also trading, and one would argue that it was probably here, and it looked exactly the same, because they tend to trade very uniformly. Don't deviate much. And it was just trucking along at the same place, just slightly higher. January was here, February was here, and then January ended, and February just took over and continued. But there's a discrepancy between the two. We call that contango, or backwardation if it's lower. And what that means is that in January, because February was trading higher, people believed that February was going to have more volatility than January for whatever reason. That is how the options priced in, the SPX options priced in. So while January is happening, imagine if it's January and someone says, hey, there's a big trade meeting between US and Europe and China, and there's if it doesn't work out, there's going to be some restrictions on trade and the global economy is going to slow down. It's going to be in March. Well, immediately, if all three volatility contracts are trading on top of each other, January, February, March, when that news happens, there's going to be a knee-jerk reaction to the downside, immediately people trading. But let's look at the long-term effects of the three contracts, right? All three contracts would move higher. Let's do a different color. So if the event was in March and now is January, we're trading now, but all three contracts, you can pick whichever one you want to trade. January will move up as the market immediately has that knee-jerk sell off of some bad news, but the bad news is delayed. It's coming out in the future, right? Possible bad news. February will do that and trade a little higher. March will do that and trade a little bit higher. These are the different volatility contracts. And just for fun, let's do April. So you see a pattern when the news is, which is March, that volatility in March is reflected here in January when the announcement was made. You can see that immediately the market would dive on some possible bad news maybe. So all the contracts go up, but they go up at different rates. And when the event is, that's the one that's going to price in the most. So when you see the contracts having different values like that, it's likely because in January, somebody, or December, whenever in the past, it was expected that this month is going to have more volatility. And this halfway point is always a really nice spot to gauge if you over or underestimate that volatility. If March rolls around and you get there and the event was like a nothing event, nothing happened, then you overprice volatility. Once it hits that midpoint where, you know, buyers and sellers, we always talk about half gaps, right? A very similar concept where you have price discrepancy. The middle is always a good testing ground. And right here at this middle, which is this one right here, the minute that you discover that you overprice volatility, you arrive at February and the market is not volatile. We have proven that it's no longer volatile. More volatile than January, sorry. It's likely to rapidly decay because we overestimated the volatility and we arrived at the destination and go, oh, it's not so bad. So when you crush below this triple B, the market is surprisingly more liquid than expected. So what we notice is that when the market has underpriced volatility and it's supporting this middle area, then the market here can rapidly expand, which means that if you're trading on a pivot, the rapid expansion throughout the day can cause the overshoots, even though you were right on the bull side. The rapid expansion comes from the idea that volatility can bump itself and hedge itself higher, which is like walking on ice and all of a sudden your foot falls through a couple of times. Because the volatility expands, it causes like turbulence in the options market. But down here, there's not really a lot of turbulence in the options market. The options market is tightening. Buyers and sellers are flooding towards the best bid and offer. It's tightening up. So in a range like this, left to its own, VIX just normally decays further and further and further. Market becomes ever so cleaner. And I'll show you some of these examples. Like this is a technique that we invented here, by the way. If you're just tuning in, this will be in like, you know, Rocket Scooter 101, but this is one of our techniques that we invented. We're just exploiting a little bit of math here. Here's an example of last month, okay? I think it was this one, December. Oh, January was here. You see how like January was here. And what's neat to take away from this is in December, people believe that January was going to be very volatile. And above here, let me show you something that's very neat. Actually, it's harder to see on this one, but I'll just take my word for it. I'll show you another one. What do you notice about the VIX itself above this triple B? This is the VIX. Remember, we talked about the VIX as the state of the SPX widening. But another thing to note is when you're trading above this triple B, tell me what you notice about the VIX itself. Above triple B, do you notice that the VIX itself widens out? So while like the VIX is a condition of the SPX movement, the VIX itself has its own movement. The VIX itself gets wider, and we call it the VVIX, the volatility of the VIX itself. It's like the next derivative of VIX, which is like a derivative of SPY. So you see how the VIX itself can actually spiral out of control above triple B as well. Imagine your exponential moves in the market just diving really quick because the market becomes exponentially thinner. So what's neat about below this triple B is the VIX loves to tighten up. And when you have those oscillations, they tend to converge very rapidly as opposed to diverge rapidly. So above triple B, the VIX itself has the ability to go out of control. And below triple B, the VIX itself, it like contains a fire very easily. Now, let me show you one where we were actually below for a long time. You can see that hot and cold difference, like nobody's business. Watch this, you guys. Here's a great example. Tell me what you notice. How's my trade doing, by the way? I'm not even watching it. I'm going to trust that it's okay. Here's this month. And it typically stays the course until the end of the month. And the end of the VIX month is the Tuesday before the third Wednesday. Write it down exactly like this. Don't skip. Don't say the third Tuesday. Because it's not always the third Tuesday. Sometimes month starts on a Wednesday. It would be the second Tuesday. But Tuesday before the third Wednesday. Third Wednesday is when VIX options expire, VIX monthlies. So the Tuesday before that, we do this calculation. You notice that the VIX itself tends to be wider and choppier. It has many times where the V's inside of it get much bigger, like here. You see how it's like really small and then it widens out? Look down here. Look at this. What do you notice about the difference between this? I don't like it. And this. Hell yeah. Tell me the difference between the two. You see how it's cleaner? Without going detailed into the math, I can explain to you why it's cleaner if you want a detailed mathematical example. And the little tiny burps that you get smaller and converge. Any news event that causes an event to happen, you see how the volatility just kind of tightens up really quick. Down here, you can just imagine that the market hates volatility. Even if it gets some, it's not going to like it unless it's a big changing event. Up here, the market more easily accepts volatility. Shit's like it's like icy roads, and here it's like nice and steady. Do you see how here any turbulence is like quickly squashed? Nice and clean movements, not a lot of bouncing in the market. Up here, any news event can cause 3, 4, 5, 6 days of turbulence. Does everyone see the difference between above that level and below that level? When the market is down here, you guys, y'all want to play your trader funding programs and go out there and win a bunch of funded accounts? Wait and do all your trades here, and you'll have such a better chance because the volatility is what fucks you up in those combines. If you want the perfect trade setup, especially if you're not a full-time day trader, and you want to wait for the most perfect trade setup, you want that volatility to be in a place where you have less probability of the market spiraling out of control. It sucks to do a month of work and have that one particular day kick you in the ass. So usually like the first couple weeks of the month, even in a bull market, are a little harder, or the first week. But if you wake up every morning, you're like, you know what? I don't trade a lot, but I need to trade only when the setup lines up. Wait for that volatility confirmation. Your market's going to be cleaner, much easier pivots. It's going to absorb bad news better than here. Here is like when you're trading up here, the CPI is the one that runs away and the market can immediately just tank. But if you're down here, futures price in the future. The expectation of the CPI is not supposed to move the market. VIX is telling you what the future looks like. VIX is the expected volatility 24 days out from the current day on the SPX, plus or minus a window of, I forgot how many days, 13 days or something like that on either side. So it's what volatility is expected to be in the future. So if we're trading down here and CPI is a week away, VIX is already telling you it's not expected to be volatile in the future. And so you're going to have very little one-offs when bad news happens compared to when bad news happens here. VIX kind of overreacts. It's a little emo up here. Does this make sense? I see red candles. Oh no. Okay. Does this make sense, everybody? So if you're going to do your trader funding programs and you want to just kind of wait through this, and these are the days where a catalyst will kick you out and you got to start over, reset. When you wait down here and just trade just this environment, you're going to have much cleaner trading. Your probability is higher that you're not getting zapped by a catalyst. So let's look at what like the S&P looked like from, I don't know, what is this, 11/1 until the end of the month. Okay, let's just do an hourly chart. Oh, that was this. Okay, yeah. So here we go. So here's the difference. Let me just clean up blank chart real quick. Like here, and you notice how whenever there's news events, the market, even big rallies, the market tightens up very quick. And you can see that there's practically no downside. Like the market, how many times the market rallied like here, and people are like, oh, let me short it. And the market just did this and then bumped up again. The market did this and bumped up again with no pullback, right? That's because there's no volatility. There's no V for volatility. You think volatility means V's. There's a V. So the idea is volatility is in a perpetual decay or being hedged lower, the probability is even higher that you're not going to have these V's or dips. Any dip's going to quickly be bought up or squashed. Even a news event is short-lived, and fuck that news event, I'm back. You see how this works? The market will absorb bad news very rapidly. those environments. The big sell-off, the next day rally. These things happen more often in that environment. Right? When you're less than that. When you're above it, look, the market can have some big sell-offs at the end of the day, big reversals. End of the day, it gets wider at the end of the day, sells off again the next day. That was that clear cut and dry around the 1st of November, right? It can be more volatile. Sell-offs can be more prominent. Bad news doesn't recover the next day as easily because the market becomes even more volatile. Even down here, right? Look. Here's a V. Here's a bigger V. Here's big V's as well. You're not getting collapsing that volatility. There's a clear shift in the way the market behaves. Less than, greater than, less than. You can see how trying to buy the dip here is a little more dangerous, so I'm going to trade smaller or understand that. You see how buying the dip here, you can trust it more. It hits and goes, hits and goes. So this is, if you're trading any index product, you need to understand volatility to this degree. What does it do to your trading, right? It affects how much you trade and how far away you split your bet. Why did I hit this with 2.5 minis right here? Because I'm expecting razor sharp pivots and I'm getting them. Maybe I might be wrong in the trade, but do you see how that affected my decision to go heavy and hard really quick? I've got no scares yet. My resiliences are clean. DD's clean. Everything's clean. Clean. And my half gap has bounced very sharply in 2 different places. Do we all see this? Yes. Type yes if you see it. I'm not expecting a lot of overshoots. But the best part about having a heavy position like this is that if it falls here and starts to trade off, I'm going to get the fuck out of Dodge. Bye-bye. I'm going to get out quick because I know I'm wrong. It shouldn't be hovering. It shouldn't be volatile. Volatility is expected to collapse very quickly. So if it's falling outside of this like support area, then every buyer in town is going to be overwhelmed by the sellers. I'm going to get out of the way really quick. And so you can see how my decision, well, I may not win the trade, but I'm going to know very quickly if I'm wrong. It's much easier to trade this environment. The market's trying not to be volatile. It's trying. And whether it sells off or not, it's okay. But at least I know I'm going to scale my confidence based on the confluence of my indicators, but also my position size confidence really does come from the idea that I'm not expecting any volatility. And as a secondary check, I'm going to go here and make sure there's no news coming out to stimulate some kind of volatile sell-off. Okay. Nothing really happening today. So nice clean day. Let's double check earnings. Typically you don't have on a big earnings day, you don't have big moves into earnings. So this is a big earnings week. Typically during earnings season, earnings days themselves, you don't have big moves during those earnings days. The market tends to already price in what the earnings is supposed to be. And then it's like the report with the forward guidance together are what move the market. So this is a big earnings week. And believe it or not, one may, if you didn't understand this, I'll teach you something new as well. You might say, oh crap, there's a bunch of big earnings coming up this week. That's going to cause the market to rally or sell off really. It doesn't. For the most part, after market calls don't create moves throughout the day. The market tends to kind of hold the fort and be stable leading up to major earnings. But Tesla tomorrow after market, you wouldn't expect Tesla to be like making huge decisive moves leading up to its earnings report. Like the Tesla's going to be breaking out and rallying or crashing or whatever. Look at Tesla today. Has kind of just held flat where it opened. It opened here, bumped around, it's kind of flat. Leading into major earnings, the major stocks tend to stay put. So the chances of spontaneous volatility or selling off leading into earnings is very rare. So I even have an extra safeguard because this is a major earnings week with no news event today. So all those things pile up into my ability to want to put in a more decisive, stronger position. The R&R on this is fantastic, right? So if you guys didn't, you're like, you watch streamers or whatever. You watch anybody trade and all they're like, oh, the color of my elephant triangle monkey snake pattern just turned green. Everybody long the market here. Let's go to the moon. let's get it. Let's go. And it's just like there's no technique. You realize that real traders are going to put in the amount of effort, like what I described to you, understanding volatility, how markets move and why they move is very important to scale your bet. You're always calculating the odds of success. What is the odd of me being right? What's the odd of me being right, but not right? Not good timing. This is kind of scaring me a little bit. Let's zoom in here. Watch this resilience number. Should I be in a bigger position? Should I be in a smaller position? Should I be in a harder position? Should I expect a strong move? Should I expect a choppy move? If you can do your best to predict how it's going to get there, it's going to affect how you're behaving that trade. Right now, because it's not rallying, a lot of people may say, and again, we're always, resilience is starting to die here. I'm going to give it a couple minutes and maybe I'll trim. Not doing anything. I still believe in it. Good. So a lot of people may say, it looks like it's going to sell off. We're getting some, it's trying to sell off and maybe the market rallied and you want to short it just because or whatever. Now it might sell. It looks like some stocks are losing before it. But the case is like, you may just say, it rallied, looks like it's going to sell off. A smarter trader will say, actually, the volatility is starting to collapse and it's consolidating. And all of their signs technically point up. And while it is trying to sell off, it's not achieving that sell-off state. So I'm more comfortable not trying to short this or something, right? The idea that you put more thought into it is the whole point of this conversation. Put a little bit more thought into it the next person. Don't just throw money in it and hope for long or short. If you can guess how it's going to behave, you're going to have a much better time with your trades. That's kind of your job as a trader. Guess how it's going to behave. We all follow? And let's watch Apple. That's starting to lose as well. I know every time let's go ahead and so now this is okay. Stocks have been selling off enough that it's actually trying to lose the fort. Get this negative resilience, it could fall a little bit lower. So let me start. My finger over the button here. Just 3. Let's see what happens in Apple. So Apple's typically like one of the stocks we look at because it's one of the big movers of resilience, right? It's market cap weighted. So if Apple doesn't bounce here, then market's going to be kind of doomed today. Look at this. Look how quickly it's moving. Resilience is a really good leading indicator of things. So let's see what happens with Apple right here. S&P wanted to fill its gap. Let's see if it supports. So remember, I expect decisive moves. So if it starts to hover around half gap and we don't do anything from here, then the market's probably going to make a stronger decisive move. My expectation is that S&P filled its gap, and as it fights for half gap again, we'll monitor this, and then I'll just cut and run if I'm wrong. Hold on 1 second. Let's see how quickly that moved. All right. So we did have a little lead up here about 4 or 5 minutes ago that it was losing. And then, of course, resilience typically, when that number is negative, it tends to push the other side of the box. So again, expecting volatility to hopefully hold. Let's see what happens when Apple bounces here in its half gap. So on this first bounce that we're going to get today, remember, I'm always expecting volatility to tighten. So market's got to fight its way lower. Without a catalyst, it's not just going to tank. It's liquid enough to support here. So right here, I'm going to make a decision again. Should I hold or fold? As the S&P retraces right back to here. See, I'm play-by-playing this today, you guys. Now I have to decide, what do I think? Am I cool here? I'm not as confident as I was. Let me start trimming a little bit in the first bounce. Every bump up, I'm going to drop a couple. It's not looking super hot. Let's trim a little bit more. Let Apple fight some more here. Give me a second. Sorry, marketplace stuff. Ooh, market still scares me a bit, but sometimes, like, I mean, see how volatility is squashed very quick? I trimmed just a little bit. I'm still somewhat confident. Resilience is still finding its way forward. We're still back above half gap. This might be the dip that we need to get the market moving. Ball rolling. Apple's bouncing here. We always talk about Apple. Whoever said Apple, pat on the back. Sam Smith knows the game super well. Proud of you, dude. Always when the good market starts looking a little wonky in resilience, we always pull Apple up. You guys pay attention. I love you. I'll pay attention. If you didn't know, the stock market is basically Apple. Apple represents so many things. There's a reason for that. Apple being such a heavily weighted stock is the reason for this, but I mean, Apple is like technology, manufacturing, raw materials, all of that goes into Apple. You have microchips and high consumer. The iPhone is the product with the highest consumer demand on the planet since inception. It is the thing everybody has. Well, I guess if you're a green texter instead of a blue texter, then we're not going to be friends. You'll mess up my group chats. But I'm just saying, just kidding. But Apple is such a heavily weighted Stock, we always cycle through the top 10 stocks just to double check. When resilience starts to fail like it is right now, first thing we always look at is Apple. We scroll down the list. Apple, Microsoft, Amazon. Which heavy hitters are failing? You see when Apple dropped half gap, you saw the S&P responded very rapidly by dropping to fill its gap. It's not a good sign for my trade. I don't like that resilience is not surviving. I kind of expect it today to be like a continuation move, but we'll see. Big fix really quick. VIX should contain itself, hopefully. The idea that VIX is trading below here with downward pressure, any downward volatility, the VIX will contain itself. So today, this is a very possible move. Let's kind of clean some of this out. How much farther? 33.50. Oh, it's only 5 points away to 75. Okay. Question is, do I want to hold the 75 on this downside here? Any downside, the VIX is going to hit resistance. So any selling off, you might get a bounce here. Let me go ahead and clean some of this out. Okay, let's trim down to there. What I'm gonna do now is I'm gonna let this hit hedge pressure. I'll take this spot here, and I'll jump back in with 10 more at hedge pressure. Let's stop right there. So any downside, you're gonna hit this liquidity map on VIX. So VIX is trying to contain itself even with its own liquidity map on top of being below triple B. Downside will be a limiting thing. So I would like to see a trade like this. That's what I want to see today. And let's hang on that one. I'm still going to hang on to it. We had a killer trading week last week. Cleaner, easier to trade markets. Oh, right. What time is it? 9:40. Sediment, Apple with everything I mentioned. Oh yeah, totally, totally. I'm still seeing this kind of pattern here. All right, so the R&R on this, let me go ahead and pop this guy up here and get that.
cash credit card, earn unlimited 2% cash back on purchases you want, like dance lessons. And on what you need, like memory foam inserts. That's real life ready. Visit wellsfargo.com/activecash. Terms apply.
All right, back. Sorry, I did some marketplace stuff. Oh, it's that head stretcher tap. Finally waiting for this to happen. Ooh. All right. Oh, what was I doing here? I'm back. Again, there we close. Ooh, resilience is starting to like try to save itself here a little bit. I'm gonna put Apple up here, and we'll check again. Apple's hanging in there. The hour turns over in 13 minutes. I'm good to trade the Europe close, bullish into close, hopefully. I'm here, you guys. I'm just hanging up some light. Whoop. Hang up some lights real quick. Wait for a hedge pressure tap. I think that's it. There she goes. That's it. Get the turn, the hour coming up. Let's hit it. All right, I'll try one more time. I agree with you, Lee. At least a half gap. Maybe half gap, I'd say. Y'all got to see the new setup, man. I got some LED lights going. I'm turning the camera back on, so the office looks pretty dope. I'll have to share it with y'all. I'll mute the mic. I'll be back. Just hanging up plates. All right, I'm back. I just came back to see. Oh, shoot. All right. Resilience. We hit half gap. I didn't even think it was going to hit that quick. I don't like today's setup. Let me close out a little bit more. I don't like that it's not doing much here. Just trim a little bit. I totally didn't see that. I disappeared for a little bit. I was upstairs. Res is just tanking. All right, fuck this. Well, you know what? Let's just call it a small loss today. I'll come back later and try again. Maybe tomorrow. Let me let this simmer. If we lose hedge push and come back, I'm just gonna walk out of this one. So I doubled down here. I should have closed at half. I wasn't paying attention, but let's call it a day. We'll see y'all tomorrow. I'll let you know if I do anything else. Love you guys. Doing like some housekeeping around the house. Building up the office for the new show. I'm excited about it. Anyways, hit the Discord, you guys. We have a brand new video that we dropped last night from yesterday's session. Hope y'all like it. Enjoy.